In late May of 2026, hundreds of highly profitable e-commerce founders woke up to their ultimate business nightmare. Without a single warning, their corporate banking lines were cut to zero, their operational cards were instantly declined, and the software platform processing millions of dollars in daily internet sales went completely pitch black. Parker, the golden child of elite Silicon Valley accelerators, a tech juggernaut boasting over $200 million in total funding and $65 million in annual revenue, had just filed for total bankruptcy liquidation. But as the official court papers unraveled, a massive financial illusion was exposed to the public. The millions of dollars everyone thought was secure venture backing wasn't what it seemed. The company's final catastrophic undoing was caused by a secret acquisition negotiation that completely imploded just hours before the system froze. To understand why Parker became the most trusted corporate card for internet brands, you have to understand the e-commerce boom. Traditional commercial banks absolutely hate online retail. They look at inventory swings, volatile digital advertising spend, and changing supply chains and see nothing but unmanageable risk. Parker stepped into the market with the ultimate solution. They offered custom corporate credit cards built explicitly for internet companies. By syncing directly to a founder's Shopify or Stripe account, Parker used specialized algorithms to underwrite massive credit limits based on real-time sales performance. The tech world went absolutely wild for the model. Backed heavily by billionaire investors and top-tier venture firms, Parker scaled with blistering speed, processing staggering sums in transactional fees and positioning itself as the core financial vault for digital companies globally. On paper, it looked completely bulletproof. But behind the glossy marketing pages lay a fundamental structural vulnerability. In the high-stakes game of corporate fintech, there is a dangerous difference between cash raised to run a startup and massive debt borrowed to fuel a credit loop. When headlines announced that Parker had secured over $200 million in funding, the public assumed the company had years of operational security. They were completely wrong. Court records filed in May 2026 revealed that a staggering $125 million of that total was actually an asset-backed credit facility. This means it wasn't cash sitting in a bank account to grow the company. It was borrowed leverage designed solely to fund their customers' card balances. Worse still, like most modern neobanks, Parker wasn't a real licensed bank. They relied entirely on underlying partnership agreements with traditional partner banks to hold customer deposits and route transactions. This meant Parker was operating on microscopic margins, burning through their actual venture runway to maintain an expensive technological platform, while remaining totally dependent on external credit lines to keep their corporate cards active. They were sprinting a marathon on a fraying tightrope. Behind closed doors in early May, the cash crunch reached an absolute breaking point. Parker's executives spent weeks locked in intense, frantic acquisition talks with a major financial institution to buy them out and save the network. On Sunday night, those emergency buyout talks completely collapsed. The prospective buyer walked away from the table with zero operational capital left to run the core software or guarantee the processing lines. The executive team had to execute a brutal call. They notified their partner banking institutions that operations were ceasing immediately. The very next morning, founders tried to swipe their cards to pay for millions in digital ad placements and inventory shipments, only to see the words transaction decline freeze their entire supply chains. Parker didn't even attempt to restructure or save the business. They went straight to a Chapter 7 filing. This means an automatic court-appointed trustee takes total control of the company, sells off every single piece of corporate property, and terminates the brand permanently. While the underlying customer deposits remained safe within partner bank vaults, the instantaneous operational freeze left thousands of companies crippled. It exposed a massive systemic flaw in the modern technology banking stack. The collapse of Parker proves that no matter how much revenue your platform processes, debt facilities cannot cover up a burning runway, and a tech company without a banking license is always at the mercy of the macro cycle. The global startup landscape is entering a historic, unyielding consolidation phase. If you want to see how another massive tech empire collapsed under identical structural illusions, subscribe and check out our upcoming deep dives. The era of unchecked growth is officially over.